and welcome to August's webinar. This is part of our best practice series, and today we're going to cover offsetting college tuition costs with tax savings and specifically highlighting some strategies that business owners and parents can do to offset some of those costs. So we've got a set time frame of 30 minutes and quite a bit to get through. So we're going to dive right in. Okay, so this is again part of our best practice series, and we've got some legal disclaimers to get out of the way. We're doing our best to present accurate information and information that's relevant to you. If you're going to use some of this, just please let us know, and we'd be delighted to make it available. A little bit about us. We're a partner without, we like to think of ourselves as partners without equity for business clients. And helping them build businesses that support their fulfilling lives. We have clients at all stages, and worthwhile plans take time to realize, and we work together to create those plans that fit them. So today we're going to look at ways to offset some of the high costs of education with tax savings, and explore some of those tax savings strategies that are available to business owners and parents. And with some planning, as you'll see a little later on, that parents will, be able to offset some of those costs. So today's agenda, we're going to cover the differences between education credits and deductions. We're going to look at specific education credits, deductions, and savings opportunities, and look at planning opportunities. And if we have time, we'll run a short question and answer so that we address everyone's questions. With that said, let's dive right into education credits and deductions. So what you're seeing here is the IRS summary, and I like their summary. It's simple. Basically, credits offset tax liabilities dollar for dollar, and deductions will be worth, depending on what your marginal rate is, a valuable deduction. So in this simple example, the taxpayer's in a 32% tax bracket. So every 1,000 of deduction, they are saving $320. So keep that in mind as we review some of the education deductions and the credits. So the first one we're going to cover is the American Opportunity Credit. And this one's worth up to $2,500 per eligible student. So how that works is the first 2,000 of qualified education expenses, basically they're education expenses where you'll receive a 1099-T for tuition. And then 25% of the next 2,000, resulting in a total credit of 2,500. So let's look at an example of how this works. So in our example, the parent pays $3,000 qualified tuition for their child, their dependent. They can claim 100% of the first 2,000, and then they get 25% of the next 1,000. So that translates to a $2,250 credit. So again, credits offset tax liabilities dollar for dollar. So basically, they reduced their tax bill by $2,250. The other credit is the lifetime learning credit. And this one is available um, for parents and dependents at $2,000 per year. And an example is, say the business owner takes a course to improve their skills costing $4,000. They can claim 20% of the expenses, resulting in a $800 tax credit. It's of course subject to the modified adjusted gross income and phased out accordingly. So that's something to keep in mind. Next, there is a savings account. It's tax advantaged. It's the 529 plan. In most cases, this is designed to encourage future savings for education costs. And this is probably one of the more common ones. So some of the benefits: withdrawals for qualified education expenses are tax-free. Business owner contributes $5,000 annually to a 529 plan for their child. Over 10 years, the account grows to $70,000. That $70,000 can be used for qualified education expenses tax-free. So essentially, there's no tax on that $20,000 accumulation. Next, we'll look at employer educational assistance programs. So businesses will oftentimes implement a plan to offset some of their employees' education expenses. And the key here is it needs to be offered to all employees in a non-discriminatory fashion. But essentially what that means is you can reimburse an employee, business owner included, up to $5,250 for tuition. So there's no tax on the employee and the business gets a tax deduction. Next, we've got business deductions for education expenses. So businesses can deduct education expenses like tuition, books, supplies, and certain transportation costs for team members that maintain or improve skills required in their trade or business. So it doesn't qualify them for a new job, but it's something that enhances their skill for what they're doing in the business. So an example is business owner spends $2,000 for an Excel course to learn how to use Microsoft Excel. It improves theirs or the team members' business skills, and the business is able to receive a $2,000 deduction, and there's no tax consequence to the employee. The caveat is that the education expense is ordinary and necessary. So ordinary and necessary as it applies to the business. So is it going to improve and enhance the skills that they're needing to do their job? Next, mention of scholarships and grants. Encourage employees and your kids to apply for scholarships and grants. The benefit is it reduces the amount that's required for college, and in some cases, these are not taxable, but usually a grant would be subject to tax. So best to check with your tax preparer on this front. And related to that, the IRS has a publication that adds a lot of details to these opportunities to save for college and achieve deductions. It's publication 970, and you could just Google it, and you're going to get a wealth of information on these and many others. So one other thing to cover is retirement savings. So you can use your IRA funds, SEP, simple, not a 401k, to fund for tuition and avoid the or not pay the 10% early withdrawal penalty when you're using it for yourself or dependents. One thing to keep in mind, although you don't have to pay the 10% early withdrawal penalty, you do have to pay income tax on those IRA funds. So we're going to look at using a Roth, which is superior to these type of retirement accounts for education. So another tax advantaged account is the Coverdale Education Savings Account. Sometimes you hear folks talk about them as ESAs. So they allow you to save for education expenses for dependents of K through 12 grades, while the 529 plan is only available to fund college. So that's a big benefit. And how this works is the qualified education expenses are tax-free. An example would be parent business owner contributes $2,000 annually to an ESA. It's available if the adjusted gross income is under 95,000 or 190,000 for married filing joint. Over 10 years, the account grows to 30,000. And in this case, the 10,000 of investment earnings, as long as they're used for qualifying education expenses, are not taxable. Another type of education savings not really thought of too much would be, say, a health savings account for a child with special education services. Those would be fair game as far as being able to distribute for the child's education expenses. Finally, I want to cover a pretty awesome potential planning idea that may or may not be available to you. If you own a business, or there's a way for you to generate some sort of business income, consider hiring your family. How this works is basically every individual can earn up to the standard deduction. In this case, it's $14,600 tax-free, because essentially the standard deduction offsets those earnings. So basically, if the child earns less than 14,600, there won't be any tax owed. And one thing to keep in mind is that it needs to be a bona fide wage from a business in order for the tax deduction, and in order for this to pass IRS scrutiny. So kind of like what that looks like, you got to cross the T's and dot the I's on this. The child needs to be able to provide a valuable service at market rates. So that's where the planning comes in. You want to make sure that you're ready, if this is available, for you to survive an audit. On the child end, they receive income below the tax amount. They can fund a Roth IRA because they have earned income. And when they use those funds for college, those expenses are tax-free. So the value essentially is, again, worth what your marginal rate is when you're deploying this type of strategy. So for every $1,000 in this example, where the business owner is in the 32% income tax, marginal tax bracket, it's worth $320. Now, this is superior to a 529 plan for saving in these ways. Number one, it grows tax-free. You can use it for education costs, or you can use it, your child would be able to use it for up to 10,000 in a first-time home purchase. And if the child doesn't use it for education purposes, they'll have a very valuable planning tool to add to their investment mix. If they don't need it for education, if they get some of those scholarships and they don't need the funds that are in the Roth, well, that Roth becomes their retirement account, which when they reach retirement age, they're able to withdraw without any tax consequences. So very, very powerful. And with some planning, you can deploy a strategy like this. So just checking back to see if we have any questions. And I'll give us a minute or two more. And if we don't have any, I'll get you out early. But the purpose of this webinar was to help you understand what's available as far as education credits, deductions, and different planning opportunities for you to help offset some of the high cost of higher education. So, well, we don't have any other questions. So with that, I will conclude the webinar. Thank you for joining us, and we'll be posting this on our website. So again, thanks, and hope to see you next month.